We all know prop firm challenges aren't easy. After all, their whole business model revolves around traders failing their challenges. In fact, statistically, a large portion of traders fail because they lack proper risk management and fall into common traps like over-leveraging or chasing trades. That's exactly why I've created this video, to serve as your ultimate survival guide for passing these challenges with confidence. Whether you're aiming for that first funded account or you're trying to get back into the game after previous failures, these strategies will help you navigate the ups and downs of prop firm challenges. In particular, I'm going to be sharing 3 essential risk management strategies which you can start implementing into your trading and start seeing results instantly. The first risk management approach I'll be discussing is the risk on, risk off strategy. This strategy states the following. For any given trade setup, different outcomes can be assigned and categorized as either high or low probability. This allows traders to optimize their returns by being more aggressive in favorable environments and more conservative when uncertainty is high. Let's break this down to better understand what it means. For a risk on scenario, let's say you enter the market during the New York session and spot a high probability setup based on your analysis of recent price action. Given your confidence, you decide to adopt a risk on approach, meaning you're willing to increase your risk exposure beyond your usual amount. For example, if you normally risk $1,000 per trade, you might increase this to $2,000, reflecting your higher confidence in the setup success. This allows you to capture more upside when the trade plays out as expected. On the other hand, if you come across a setup which meets your criteria but does not have as strong confluences, you would take a risk-off approach. In this case, you would reduce your exposure to $500, safeguarding your capital against the probability of an unfavorable outcome. This helps you protect your account from unnecessary drawdown, preserving capital for higher probability opportunities. Now, if you guys want a detailed structure on the way I trade, as well as keeping up to date with my trade ideas, make sure to check the link in the description down below for the all-in-one access to the Discord channel. The next risk management approach is the equity-based scaling strategy. This strategy operates on a dynamic risk, stating that as the equity of the balance increases, so does the predetermined risk. And as the equity of the balance decreases, so too does the risk. This method allows you to capitalize on your gains during winning streaks whilst minimizing losses during downturn. The primary goal is to ensure the size of the position adjusts relative to the account balance, protecting your capital during rough times and accelerating growth when you're performing well. For example, let's say before you start your 100k prop firm challenge, you establish a set of rules where initially you'll be risking 1% of the account balance per trade. As the equity grows above 4%, you then increase your risk to $2,000, which is 2% of the account balance, maximizing profits. However, if your account equity was to fall below -5% of the original account balance, you would then reduce your risk to 0.5%, which is $500. This system works like compounding on the way up, enabling bigger wins with each positive trade. Meanwhile, on the way down, it acts as a capital preservation tool, reducing exposure and preventing heavy losses. The third risk management approach is the break-even trailing stop strategy. This strategy is designed to lock in profits whilst reducing risk as price moves into your favor. As price advances into profit territory, you progressively trail your stop loss to secure gains and minimize exposure to the market reversals. The key goal here is to reach break-even as quickly as possible, meaning you eliminate the risk of loss while still allowing the trade room to breathe. Whilst this strategy is straightforward, it's incredibly effective when used properly. It works best when your stop loss is trailed in accordance to market structure. For example, let's say you're in a trade with a well-defined stop loss and an open take profit. You've entered based off a strong trend and now plan to ride the trend as long as possible. As price begins to form higher highs and higher lows in an uptrend, you continue to trail your stop loss below each higher low. This allows you to protect profits as price moves in your favor. Eventually, when price does reverse, it ends up taking you out for a nice profit. Now that wraps up the 3 essential risk management strategies. I hope they gave you some valuable insights to level up your trading. If you guys enjoyed this video, be sure to drop a like and subscribe and comment down what risk management strategies you use. Thank you guys for watching, and I'll see you guys next time.